Welcome to the Money Report Unfiltered. In this video we are going to review the 3 biggest misconceptions of dividend stocks. Before we get started, please remember to subscribe and hit the notification bell for updates on our latest videos. Dividend stocks. One of the first things most investors learn is that dividend stocks are a wise option. Generally thought of as a safer option than growth stocks, or other stocks that don't pay a dividend, dividend stocks occupy a few spots in even the most novice investors' portfolios. You might be surprised to know that not all dividend stocks are the safe options we've been led to believe. Like all investments, dividend stocks come in all shapes and colors, and it is important to not paint them with a broad brush. Understanding the 3 biggest misconceptions about dividend stocks should help you choose better dividend stocks for your portfolio. 1. High yield is king. The biggest misconception of dividend stocks is that a high yield is always a good thing. Many dividend investors simply choose a collection of the highest dividend-paying stock and hope for the best. For a number of reasons, this is not always a good idea. For example, take a look at a weekly list of monthly dividend-paying stocks. We have left a link in the description below. When you screen stocks for the highest dividend yield, the top names are not always the top performers on a total return basis. The stock may have a very attractive dividend of 20%, but if you investigate further, you may find the stock actually has a negative total return for a specific date range. Therefore, it's very important to also review total return, not just dividend yield. Remember, a dividend is a percentage of profits that a business pays to shareholders in the form of cash. Any money that is paid out in a dividend is not reinvested in the business. If a business is paying shareholders too high a percentage of profits, it may be a sign that it has little room to grow by reinvesting in its business and may not have much upside. Therefore, the percentage of profits a company pays out to shareholders, known as dividend payout, is a key metric to watch. Some sectors of the market have a standard for high payouts, such as real estate investment trusts and master limited partnerships. These companies have high payout ratios and high dividend yield because it is part of their corporate structure. 2. Dividend stocks are always boring. When it comes to high dividend payers, many investors think of utility companies and other slow-growth businesses. These businesses come to mind first because investors often focus on the highest-yielding stocks. If you lower the importance of yield, dividend stocks can become much more exciting. Some of the best traits a dividend stock can have are the announcement of a new dividend, high dividend growth over recent years, or the potential to raise the dividend amount. Increasing the dividend can happen even if the current yield is low. Any of these announcements can be a very exciting development that can jolt the stock price and result in a greater total return. Sure, trying to predict management's dividends and whether a dividend stock will go up in the future is not easy, but there are several indicators. If a stock has a low dividend payout ratio, but it is generating high levels of free cash flow, it obviously has room to increase its dividend. On the other hand, if a company is taking out debt to maintain its dividend, that is not a good sign. Earnings growth is an important indicator, but keep an eye on cash flow and revenues as well. If a company is growing organically, then it may only be a matter of time before the dividend is increased. However, if a company's growth is coming from high-risk investments or international expansion, then a dividend could be less certain. 3. Dividend stocks are always safe. Dividend stocks are known for being safe, reliable investments. Many of them are top-value companies. The dividend aristocrats also form a list of companies that have increased their dividend annually over the past 25 years and often considered safe companies. When you look in the S&P 100, which provides a list of the largest and most established companies in the US, you will also find an abundance of safe and growing dividend payers. However, just because a company is producing dividends doesn't always make it a safe bet. Management can use the dividend to satisfy frustrated investors when the stock isn't moving. Therefore, to avoid dividend traps, it's always important to at least consider how management is using the dividend in its corporate strategy. Dividends that are consolation prizes to investors for a lack of growth are almost always bad ideas. In 2008, many financial stocks' dividend yields were pushed artificially high due to stock price declines. For a moment, those dividend yields looked tempting, but as the financial crisis deepened, and profits plunged, many dividend programs were cut altogether. A sudden cut to a dividend program often sends stock shares tumbling. The bottom line. Ultimately, investors are best served by looking beyond the dividend yield to a few key factors that can help influence their investing decisions. Dividend yield in conjunction with total return can be a top factor, as dividends are often counted on to improve the total return of an investment. Looking only to safe dividend payers can also significantly narrow the universe of dividend investments. Many dividend stocks are safe and have produced dividends annually for over 25 years, but there are also many companies emerging into the dividend space that can be great for dividend portfolios as their businesses stabilize for the long term. Now that you know the 3 biggest misconceptions about dividend stocks, you have more knowledge to choose which dividend stocks are right for you. Thanks for watching. Please remember to subscribe.